I thank the gentleman very much for yielding, and I especially thank him because I have the feeling today that we're not going to see too much opposition to this piece of legislation, which I have some very deep concerns about. Mr. Speaker, today we will be asked to put at risk some $70 billion of taxpayers' money for a potential bailout of commercial banks. Within a few days, we will be asked to appropriate another $80 billion of real money, no ifs and buts about that one, in order to bail out the savings and loan industry on top of the $80 billion which was appropriated in the past. Mr. Speaker, the American people are angry and frustrated with politics as usual, and ladies and gentlemen, what we are seeing today is politics as usual. The rich get richer, the poor get poorer, and the working people and the middle class are asked to bail out banks which were destroyed by the greed, irresponsibility, and the outright dishonesty of many banking officials, both within the S&L industry and the commercial bank area. Once again, it is the Robin Hood proposal in reverse. We take from the poor and we give to the rich. Mr. Speaker, we must protect our banking system and the bank depositors. There's no argument about that. But we can do it without increasing the deficit and without hitting up the ordinary people of this country. Let us show a little bit of courage in this body and not increase the cynicism which working people of this country already feel. Let's ask the people who caused the crisis and who have the money to fund this bailout to do so, and not the ordinary American. Mr. Speaker, what all of this amounts to is, in fact, that some of what my friends and colleagues have said is not necessarily the case. Let me refer to my friends who have said, hey, don't worry, taxpayers, there's no bailout. Let me refer you to the Washington Post, Sunday, October 27th. Quote, the banking industry, this is an article by Jerry Knight. Quote, the banking industry is supposed to pay back the money with interest so that ordinary taxpayers never feel the bite. But congressional Democrats and many banking economists fear that U.S. banking is simply too weak to repay the money. The unprecedented loan from the U.S. Treasury is only one part of what Cleveland State economist Edwin Hill believes will be a $200 billion investment needed to restore the health of the banking industry, end quote. Let me continue. Robert Duger, chief economist for the American Bankers Association, said that bankers are confident that with enough time they can replenish the deposit insurance fund and pay back the loan to the FDIC. Quote, Washington Post. But Democratic Banking Committee leaders in Congress are skeptical. House Banking Committee Henry B. Gonzalez flatly predicts the banks will not be able to repay the FDIC loan and the taxpayers will get stuck with the bill. End of quote. Mr. Gonzalez and many economists all over this country are not the only people who feel that the taxpayers will eventually get stuck with the bill. Now, what's going on here? In fact, what this whole discussion amounts to is there is real concern that taxpayers will have to bail out the FDIC. We hope they will not. We all hope they will not, but they may. And I am deeply concerned that the rules before us today do not allow us to vote for amendments which would provide us with sufficient protection for the taxpayers so that in the eventuality the taxpayers may have to bail out the commercial banks, the taxpayers have good protection. Mr. Chairman, let me make a few suggestions. In my hope that this legislation is defeated, let me offer a few ideas as to how we might proceed. Number one, in terms of both bailouts, the S&Ls and the commercial banks, we should be honest and address them together. Ultimately, if the worst scenario comes through, it is going to be the taxpayers who have to bail it out. Let's look at it together. Let's understand we're talking about this week $150 billion of possible taxpayer bailout. Number two, as we contemplate the nature of this bailout, we must pledge not to simply dump the money into the deficit as the President and the Congress have done so often in the past. We've got to have the courage to do it on a pay-as-you-go basis, not dump the money into the deficit. Thirdly, as we discuss where the money is going to come from, we have got to have the courage to say that the payback does not rest.
Time of the gentleman has expired.
Can I get 2 more minutes?
Yield 2 additional minutes.
Gentleman is recognized for 2 additional minutes.
I thank the gentleman very much. We have got to have the courage to say that the payback, neither for the S&Ls or the commercial banks, should lie on the backs of working people, middle-income people, and the poor. As everybody in this room knows, in the last 10 years, the richest people in our country have become much richer. Middle class has seen a decline in their standard of living. The rich who have gotten richer are paying less in taxes. Working people who have gotten poorer are paying more in taxes. We cannot dump this payback onto the backs of the working people. Mr. Speaker, a number of proposals have arisen, both in this body and in the other body, which address the bailout in a fair and progressive way rather than on the backs of working people. Senator John Kerry of Massachusetts, for example, has proposed a federal wire tax, which is a clearance transaction fee on the exchange of money on the two systems which transfer funds between banks internally and abroad, the Fed wire system and the clearinghouse interbank system. He suggests, the suggestion there is that if we put a 2-cent tax fee on every $100 check, that would raise $80 billion a year, more than enough to cover all of the bailouts, and that would fall on those people who can afford to pay it, who are involved in the business. Congressman John Cox, a member of the Banking Committee, has suggested an approach by which healthier banks could lend money to the FDIC, which would create a situation in which the banks themselves would provide all of the needed money for the FDIC recapitalization. While the faith and credit of the U.S. government is still involved, this clearly is a much safer approach than what we're proceeding with right now. Mr. Speaker, let me conclude this. Don't let anybody kid you. What we're talking about here at a time when our people, 2 million people, are sleeping out on the street, where our kids are hungry, where our people can't afford health care, we are talking this week about a potential liability for the taxpayers of $150 billion before interest, stretched out over a 30-year period. Let's have the guts to do the right thing, stand up for working people and middle-income people, and make this into a progressive payback approach. I thank the gentleman very much for your time.
Gentleman from California.